quickly, we could also lower the OCR. So talking about any alternative monetary policy measures are very early on, and I don't see that at all in the near term. I did mention financial stability risks, and there is a very unlikely situation where you might need to do something for financial stability concerns, but typically that would be very temporary in that case. But I don't see that at all right now. On inflation, we are doing some internal work, and when we have the next monetary policy meeting on April 8th, we will comment a bit more in detail about the inflation outlook, and then we'll have a full set of forecasts at the May monetary policy meetings, because that's when we present the full set of forecasts.
So the Reserve Bank has already signalled a lift to the official cash rate later this year. Are you suggesting that it could come soon?
I'm saying that I will not rule out neither rate hikes nor rate cuts because of the uncertainty in the global environment. Our mandate is to keep inflation low and stable over the medium term, and we will do what we need to do to ensure that households know that inflation will, even if it's a little bit higher in the near term, it will come back to a low and stable level over the medium term.
Thank you. And how important is it that any government support not contribute to inflation?
So our focus is on monetary policy. What I say in the speech is that targeted and temporary measures, we don't expect that to give any additional inflationary pressures.
In regular business visits, I think you've been talking to businesses about their pricing intentions, about wage increases and so on. Should we interpret any of your commentary today as effectively a warning to those businesses to think carefully about that kind of pricing strategy?
Definitely not a warning. I would say that we do listen very carefully to what businesses are saying. There are lots of differences. Some businesses are doing well and have been doing well for some time. Some businesses are struggling in this environment, and they will be facing higher cost pressures in this environment. And I think the key message is that for those businesses who have the ability to see through temporary cost pressures, that would be really welcome in the longer run. But again, it's up to each and every business to make their own decisions. I cannot give a comment on how receptive they are to that notion, because it's really up to each and every business to make their own decisions.
Lucy from Reuters. You've talked a little bit about the fact that we're seeing the early stages of a recovery. Can you talk to me about where you are seeing that recovery and where you're concerned that what's happening overseas is going to start to impact various sectors?
Yeah. So on growth, we got new GDP numbers for the fourth quarter of last year a few days ago, and that was a little bit weaker than we expected, but it really also confirmed the view that we have, that we are actually seeing a recovery, but we're still at the early stages. What we saw in the GDP numbers is that the recovery is broadening, so there are more sectors that are actually growing, but we would like to see more of a growth momentum going forward. So I think that those GDP numbers confirm that view, and now we'll be very vigilant because, with a little bit higher cost pressures, exporters might face somewhat weaker demand from their key trading partners. Asia is very hit by higher oil prices and gas prices. Households could be a bit more cautious. Firms might wait a little bit with investments. But it's very different, because I'm certain that some firms will also continue with their investments plans, etc. So we'll be very carefully watching this, and I'm hoping to meet many businesses and hear directly from them as well. I will this afternoon.
Financial markets in recent weeks have started pricing in 3 rate cuts and a rise in the official cash rate to 3% by the end of the year. They did something similar at the end of last year, which turned out was a bit ahead of
Well, I've been careful to always stress that, I'm not going to say whether markets are right or wrong. What we noticed is that wholesale interest rates have been going up. It's a global trend. What we're also seeing is that is already translating into higher mortgage rates for households and also businesses facing that. So it means that what we call financial conditions is tightening. That could dampen growth a little bit in the near term, and that is something we take into consideration. We also hear from market participants, from our own analysts, that there are some liquidity reasons why market pricing has moved that much. So it doesn't seem that everyone has those expectations, but because of the way that the market and low liquidity in the market, global trends tends to transmit into New Zealand pretty quickly.
But from the tone of your comments about not ruling in or out a high court cut, it appears the markets have tightened when the Reserve Bank itself doesn't necessarily want to tighten or cut right now. So are you okay with them tightening?
Well, again, there's so much uncertainty in the global environment, and there is uncertainty exactly how this will transmit into inflation and growth, that we're being vigilant to what is happening. What we say is that we don't want to react too soon to inflationary pressures that we can do little about, but we don't want to wait too long in case we see those inflationary pressures being more long-lasting. And exactly what that means for the OCR will depend on what we see happening in the economy and how these conflicts evolve over the coming weeks and months. So it's still the case that if this is a relatively short-lived shock, then this will be more temporary, even if the effects will linger for some while. If this lasts for a long time, then we're more likely to face more challenges in terms of the inflationary pressures.
And in 2022 and 2023, central banks looked through that energy price shock from the Ukraine war. You're saying we should look through it again. What's different this time than last time? Because some people think that was a mistake.
Well, I think that there are both similarities and differences. It was different because both global demand and demand in New Zealand was much higher at that point in 2022. So there was both a supply shock and a demand shock pushing up inflation at that point. Now we have weaker demand compared to then, weaker labor market, for example. So that makes a difference. And we are looking at that, but we're also taking the lessons from 2022. So we're looking very carefully at inflation expectations, price setting behavior by firms, to see if we see anything early on in the data that there are risks to medium-term inflation, then we will act.
You said there's spare capacity this time around that makes things a bit different, and that businesses will find it difficult to pass on price increases. But for most consumers, they're going to supermarkets, insurers, fuel retailers, banks, paying for electricity, all of which have been subject to market studies because there's concerns they are using monopoly powers to increase profit margins and did do that sort of thing during 22 and 23. What's to stop them from doing it again, given there seems to be not the same market disciplines within as other parts of the economy?
No, but I think what you will see is that there are some prices that are already going up. And the thing that you're pointing out that's really important is that it's often necessities. So many people have to buy petrol or diesel for their firm or for their household just to drive to work, for example. And that will, for some households, it will crowd out other consumption. And that will mean that demand for some other goods and services will be lower. And we are looking into all these kind of channels and how that is affecting prices over the medium term. But it's true that this is going to be challenging for some households and firms in the near term, and they will also affect other firms and businesses.
Hello, Dita Dwayne from Economists. I just wanted to ask you, if all the war was to end today,
It's a difficult and very good question, because even if we saw that the immediate conflict is stopped in the near term, I do think that it will take some time for supplies chains to normalize again, because there's been a severe disruption. So we're likely to see some effects linger for some time, and exactly how long and how severe it will be, that's the kind of thing that we're really looking into right now, and that will be important for our decision in April. But even if it stops now, we will see some effects lagging in the data coming out over the coming months.
You mentioned the Kiwi dollar in your speech. How concerned are you that we will import inflation through the dollar?
So the Kiwi dollar has weakened a little bit, but not much over the past few weeks. And that is after several months when there was quite a substantial appreciation, so a stronger Kiwi dollar. So if you look over the year in trade-weighted terms, the Kiwi dollar is approximately unchanged. So I think currently will not have it could have some, but not a substantial effect on inflation. It shouldn't. Then there's always some details in that we're looking at. You know, it's a little bit weaker against the Australian dollar, but that's probably benefiting the exporters, not so much import from there. It's a little bit of an effect against the US dollars and then strengthening towards some others. So we're taking all of that into consideration, but it's a relatively small weakening of the Kiwi dollar currently, after it's strengthened.
I'm just wondering if you could give me a bit of a sense of how much extra contact that you have with the finance minister during this crisis, or is it, this conflict, or is it exactly the same as it has been, or what's the communication between the two of you like?
No, so I think it's important, first of all, that monetary policy is independent from the government. So when we move into the monetary policy deliberation, it's the Monetary Policy Committee that make those decisions without any advice or instructions from any government. That's really, really important. Then in a situation like this, where there is a lot of uncertainty about what's happening and how it's affecting New Zealand, it's important to share information. So there's been a few meetings just to ensure that we discuss potential impacts and what we're seeing in actual data and the information we're getting from global meetings and that kind of thing. Yeah.
You mentioned earlier that if required, you might have to do some short-term things around financial stability. I'm just wondering, what options might be on the table there? Would it be sort of liquidity for the banking sector, and what that might be? And completely unrelated to that question, just are you concerned at all that we might see stagflation?
So again, I have to stress that markets, despite a lot of volatility, financial markets have been functioning well. So I really don't see any near-term reasons to think that we would need to use any of the tools that we have, but we could provide liquidity. We could also potentially do bond purchases again, but as I said, it's highly unlikely, and it's nothing that we see any reasons to expect that we would need to do. It's just that we can do it if the situation became much, much more worse than expected. And what was your second question?
Whether you have any concerns that we might see stagflation?
I don't have concerns right now. I think what we do expect is some higher near-term inflation and somewhat weaker growth momentum, but we still expect the economy to grow this year. And again, if this supply disruptions and the higher oil price, if it turns out to be temporary, I do expect to see really decent growth later this year. But in the near term, I think we'll see households and maybe some firms being a bit more cautious.
Working along this table. Just reflecting, this is a very broad question, but reflecting on your move from the other side of the planet, does your gut instinct feel like distance insulates the New Zealand economy, or does our small size and our long supply chains put us at greater risk and greater vulnerability?
So it's a very interesting question, because I think I'm so focused on the New Zealand economy right now that I haven't really looked so much at what's happening on the other side of the planet, except from just in terms of the global trends. I think there's some strength in New Zealand as well that we shouldn't forget. One of them is that, yes, we're vulnerable to global supply chains. We're vulnerable to needing to import things by shipping. But we also have, for example, our own electricity generation, which is not the case in all countries. So in many countries, electricity prices are dependent on gas prices. And that kind of effect we're not expecting here. I know that the storage levels for fertilizers are in a good level right now. We do have an extremely competitive agricultural sector that will perform well throughout this. So there are definitely vulnerabilities, but there are also some strengths that are important that we remember in this kind of environment.
Okay. I know obviously you're very focused on that sort of that medium-term inflation target, but I suppose how do you see the current crisis affecting potentially the labour market? Potentially as a lot of smaller businesses are looking at costs with those rising fuel costs and maybe reassessing their labour costs.
Yeah. So we'll be watching the labour market very closely. What we've seen in recent data is labour market still being weak, but signs of the labour market strengthening. So it will be important to keep on looking into that data in detail to see how the economy evolves going forward. But the latest data we have is still before the oil price shock that we're facing right now. I think, is that the last? I'm afraid that had to be the last question. So thank you very much for coming today. Thank you.